Time flies. Tesla stock is up 4.3%. Tesla stock is up 4.3% after missing deliveries in a very major way. I mean, this was way worse than expected. I think it's 336,000 something deliveries, goes to show how low the demand has become. The idea that this is because of Model Y refresh is completely asinine. We can see how low the demand is in China for the new Model Y, and most people can't even tell the difference between the old Model Y and the new Model Y. So clearly, this is driven by brand damage that Elon's political activism has caused, as well as higher than usual interest rates. But we don't know when the interest rates are going to come down. That's TBD. So we're stuck with low demand for vehicles, including the Model 3, the Model Y, the Cybertruck, and the Model S and the Model X. So every single vehicle Tesla produces in every market has low demand. So this has nothing to do with Model Y refresh. Any claims to the otherwise are just completely misguided. All right, let's continue with our usual Reuters article. Dow Jones up 0.7%, Nasdaq up 1.3%, S&P 500 up 1, Russell 2000 up 1.3%. Max 7 are driving the markets higher. Tesla up 5.5%, Nvidia up 1%, Amazon up 2.5%. I think they made a bid on TikTok, which I guess TikTok decision may come today. Meta is up 1%, Apple is up 1%, Microsoft is up 0.4%. These are the most traded stocks. CoreWeave stock continues to be extremely volatile. Rivian is down 5%, which is interesting in this market. Let's see what else. Oil prices are up 1%. Crude oil is now at $72 per barrel. The yield curve is up across the board, 5-6 basis points. I believe the probability of a rate cut being priced in the markets for May is 9%, down from 20% yesterday. Down from 20% yesterday. I don't think there's going to be a cut. I think the probability of a rate cut in May meeting, which is on May 7, so just a little more than 1 month, is extremely low, less than 1%. I think the market is way off in pricing in a potential cut for May. I just don't see that happening. Especially with these tariffs. So we're going to get the tariff news on at 4 o'clock in a couple hours here. I think there's going to be some tariffs. The administration has been floating the number $100 billion raised from all the tariffs and $600 billion raised from overall tariffs. And I think they need that for tax cuts later this year. So without getting that number, I think they can't pass continuation of these tax cuts. I don't think the market will allow that. So I think they're in a big pickle here because Canada, Ontario PM said today that if US drops tariffs, that they would drop tariffs. I don't see how that's. He also, I watched the full interview. It was a CNBC interview with Andrew Sorkin, and it didn't. It kind of sounded like it. He said it in passing, and he was all skittish about whether they would drop what they recently implemented or all of the tariffs. And if it's just recently implemented tariffs, I don't think that means much. But if if North America, so I actually did some research on this. If North America went to zero tariffs anywhere, that would boost GDP by about 0.1 to 0.5%, depending on how that plays out. And the inflation expectations would come down just a little bit. But um, I don't see how that could be a global thing. Like South Korea um, puts a lot of tariffs on US imports, China puts a lot of tariffs on US imports. So I think it could potentially in the next few weeks turn out to be lower tariffs in North America. I just don't see how that can turn into a global no tariffs kind of thing. I think it's a low probability scenario. My base case scenario today for 4 p.m. is that there's going to be some tariffs, maybe 10 to 15% across the board as a starting point, and then we'll see how the negotiations pan out after that. I think these things are going to go on for months. I don't think this is I think the uncertainty will continue. And Besant today said that what's going to be announced today is going to be the max on tariffs. But I don't know how he can possibly know that. Because let's say, for example, US comes out today and says 10% tariffs on Europe, EU. And then Europe comes out and says, well, um, uh, we're now going to do another 10%. How can Trump not counteract that? I don't think that's possible. So um, I think Bessent may have kind of jumped the gun over there. And I was listening to some of his interviews, and he sounds a little tired. He sounds very tired because he's like the only sane person in the entire cabinet. So, all right. Tesla stock is up 5%. We're gonna read. Give me 1 second. All right, let's read this Reuters article. Markets on high alert ahead of Trump's tariff plan reveal. Global investors are close to getting some clarity on Trump administration's tariff plans on Wednesday, but with little detail on what to expect, financial markets remain on edge. Trump has for weeks pegged April 2 as Liberation Day when he plans to impose an array of new tariffs that could upend the global trade system. Tariffs could have big implications for corporate earnings, global growth, inflation, and Fed interest rate policy. Investors had kicked off the year with high hopes for pro growth policies from the Trump administration, but have been spooked by a barrage of tariff related headlines. While investors broadly agree that Wednesday's long awaited announcement could be pivotal for the near term outlook for global financial markets, they are unsure about which way prices will swing and what will come next as negotiations could be protracted. I can't recall a situation where the stakes were this high and yet the outcome was so unpredictable, said Steve Salchnik, chief strategist at Interactive Brokers. The devil is going to be in the details, and nobody knows the details. US stock indices opened sharply lower on Wednesday before pairing losses. Indices are actually up now. Safe haven gold near record highs, and European shares fell on Wednesday, with stock 600 benchmark down about 1%. The White House said on Tuesday that Trump will impose new tariffs on Wednesday without providing details about the size and scope of trade barriers that have businesses, consumers, and investors fretting about the intensifying global trade war. White House spokesperson Caroline Leavitt said reciprocal tariffs on countries that impose duties on U.S. goods would take effect once Trump announces them, while a 25% tariff on other imports will take effect on April 3. Lack of clarity on whether there will be one flat tariff rate for all imports or whether the administration takes a more fragmented approach has made modeling the ultimate impact of the tariffs on earnings, growth, and inflation a daunting challenge. Ideally, we just get one number and then we can figure out the downstream impacts, said Sonu Vengris, global macro strategies at Carlson Group. But my fear is that we don't get that, or even if we get one number, that will be subject to negotiations, he said. Amount walk Wednesday's announcement feels particularly crucial after the S&P 500 confirmed a correction, a drop of 10% from a recent high in mid-March. The index was last down about 8% from its February record high. We are at a serious, very tenuous spot, being at the bottom of a corrective trading range. That leaves us poised for either a very sharp bounce or a scary breakdown. So we'll go up or down. That's very insightful. Heightened uncertainty over the tariff news and potential market reaction lifted the CBOE Volatility Index to more than 2-week high of 2480 on Monday. The index was up 0.9 points to 22.69 on Wednesday. I think the market is really holding its breath, said Mark Spindle, CIO at Potomac River Capital, who expects a so-called fear gauge to climb toward 30, a level associated with a high degree of risk aversion. Traders in the options market were braced for a roughly 1.3% swing in the S&P 500 on Wednesday. The tariff announcements could also spur sharp moves in the dollar, euro, and safe haven gold. US manufacturing contracted in March after growing for 2 straight months, while the measure of inflation at the factory gate jumped to the highest level in nearly 3 years as anxiety rose over import tariffs. Survey data out on Tuesday showed. Recent tepid consumer spending numbers have raised the specter of lackluster economic growth and higher inflation. That could put the Fed, which paused its easing cycle in January to monitor the impact on tariffs, in an uncomfortable position. For Anthony Saglin, chief market strategist at Ameriprise Financial, the risk is that Wednesday's announcement will offer no clarity on tariffs. The market, to some extent, has discounted the cumulative negative effect of tariffs on potential economic growth and corporate profitability, he said. The negative reaction in the market would be if the details of those tariffs still leave open a lot of questions about what it includes, who it includes. Investors flummoxed by the wide range of possible outcomes from Wednesday's news would do well to not put all their eggs in one basket, analysts said. The bottom line is, in the face of uncertainty, there is flirting at levels that we haven't seen since the pandemic or the financial crisis. You need to be diversified, CIO Crescent Capital said. Okay. So we're going to go up or down, and so be diversified. It's the article summary, basically. Thanks. Factory orders came in for February at plus 0.6, more than the expected 0.4%. ADP employment change for March was 155,000, more than the expected 120,000, and more than the prior 84,000. On Friday, so tomorrow we're going to get initial weekly claims, and on Friday we'll have non-farm payrolls and the non-farm private payrolls at 130, 120,000 respectively expected. Prior numbers were 151 and 140,000. Yeah. I think this level is actually pretty consistent with non-accelerated inflation given the deportations. So unemployment rate is 4.1%, expected to be 4.1%. All right. Newsmax is down 50% today. This is a recent IPO that went up 25 times from the IPO price. And the reason being the float open for public trading is only a couple percent. So they opened up very little part of the float, the company, to public trading, which was the cause of the insane manipulation, going up 25 times in the first 2 days, then coming back down more than 50% as of right now. And CoreWeave, I was looking into the S1 for CoreWeave a little bit. So CoreWeave is up 7% today. It also went up a lot in the yesterday. There was a bit of a short squeeze, especially in the morning. But towards the end of the day and this morning, there was a bit of a short squeeze on CoreWeave. But it's come down a little bit. It saw the high of 65 and now at 56. So we can take a closer look at that S1, take a little bit to do that. And then I also want to look at this ADP report. Private companies added 155,000. This is definitely more than expected for March. No question about that. So let's see if we can get some details here. Manufacturing delivered stronger than average job gains for the second straight month. Construction hiring slowed. Natural resources and trade, transportation, utilities lost jobs. Despite policy uncertainty and downbeat consumers, the bottom line is this: the March top line number was a good one for the economy and employers of all sizes, if not necessarily all sectors. So, in recent months, we have tremendous increases in education and health services employment, as well as some increase in construction. Although I think construction employment is about to plunge, or at least peak and then decline going forward. Um, and some increase in mining. Well, I didn't realize natural resource and mining employs about nearly 30 million people, 29 million people. That's crazy. And then second largest is education and health services, 26 million people. And then after that is professional and business services, 23 million people. Information services are only 3 million. Hmm, okay. Change by establishment size, everybody is up, small, mid-size, large, everyone saw increases. Change by industry. Natural resource and mining dropped. Construction increased slightly but slowed. Manufacturing jumped 21,000. On services front, trade, transportation, and utilities went down by 6,000. We've also seen very dramatic slowdown in FedEx, UPS, etc. Which some people say could be an indication of what's to come for the macroeconomy, but maybe. Information went up by 3,000. Financial activities went up by 38,000. Professional and business services went up by 57,000 in March. Educational health services up 12,000. Leisure and hospitality up 17,000. Other services up 11,000. The West lost jobs. Pacific went down by 29,000. Mountain went down by 12,000. And the job gains were mostly in Northeast and Midwest. Okay. Job stairs saw their pay increase 4.6%. Job changers saw their pay increase 6.5%. These are higher than what's consistent with 2% inflation. So even wage inflation is a little higher than there should be. Pretty uniform across industries. Medium and large size firms saw the higher pay increases. Small firms with 1 to 19 employees saw a 2.9% increase for wages. Okay. Let's look at this S1 a little bit. I mean, this is a very long document, but maybe we can get started. And these are 50 pages. We can get started, read the first few pages, and maybe continue tomorrow. Very intrigued by this business and see if I can get some insights into the industry too from this filing. there any questions? Feel free to request to speak. Otherwise, I'm going to read a few pages and then we're going to call it a day probably. There was some speculation that Elon might be exiting Dodge, and then but then he was denied, etc. So a bunch of rumors and um, nonsense. But I don't think it makes much of a difference. Okay. I think Tesla is in a tough position either way. Whether Elon returns to Tesla or not, it's in a tough position. Bankers on the CoreWeave IPO: Morgan Stanley, JP Morgan, Goldman, and then Barclays, Jefferies, Citigroup, Wells Fargo, BofA, Bank Guggenheim, Santander, Stifel, Macquarie. Everybody basically. $1.9 billion 2024 revenue, $0.9 billion 2024 net loss for the year ended December 31, 2024. So they made 2 billion, lost 1 billion. So expenses were 3 billion for last year. 737% revenue growth, 2023, 2024, 17% 2024 operating income margin. But this has got to be, that's got to be adjusted. So we're going to look at the income statement later. 19% adjusted operating income margin. Okay, interesting. So how the fuck did they lose 1 billion if their operating income margin is 70%? Okay. $15 billion 2024 remaining performance obligations, 1.3 gigawatt contracted power, 250,000 plus GPUs online, 32 data centers. So if I multiply 250,000 times $30,000, this could be close to $10 billion of revenue for NVIDIA CoreWeave as one client. So it's definitely a top 5 type of client for Microsoft. I mean, NVIDIA. Contracted power represents the sum of all power globally CoreWeave is contractually obligated to procure or lease based on all signed contracts at any point in time. Okay. Purpose built for AI, third-party tooling solutions, application software services, managed software services, infrastructure services, data centers, cloud ops, fleet ops, node lifecycle controller, mission control, etc. Okay. My understanding is a very commodity business, but it was kind of in the right place in the right time for the last 2 years. Superior performance and efficiency. Up to 20% improvement is MFU. CoreWeave helps bridge the MFU gap. Okay. Training. 3.1 million GP hours saved on training Llama 3.1. 50% fewer, I don't know what that means. 50% fewer interruptions per day. 2.16 for Llama 3 and a 0.96 for CoreWeave. Fewer interruptions per day. Adjusted down to match cluster size of the example CoreWeave job. 3 to 5x faster model download speeds and generalized iCloud storage solution. 8 to 10x faster container spin up times, major generalized cloud provider. Revenue went up 10x in 2023, 8x in 2024. Significant revenue visibility and strong in economics. 15 to 25% weighted average prepayments. 96% of revenue from committed contracts. 4-year weighted average contract duration. as of December 31. 4-year weighted average contract duration. Okay. Definitions of the words to be used. CoreWeave powers the creation and delivery of the intelligence that drives innovation. Yeah, okay. We are the AI hyperscaler driving the AI revolution. Our CoreWeave cloud platform consists of our proprietary software and services that deliver the software and software intelligence needed to manage complex AI infrastructure at scale. Our platform supports the development and use of groundbreaking models and the delivery of next-gen AI applications that are changing the way we live and work across the globe. Our platform is trusted by some of the world's leading AI labs and AI enterprises, including Cohere, IBM, Meta, Microsoft, Mistral, NVIDIA, and OpenAI. We believe AI is the next frontier for innovation in technology, driving productivity and efficiency gains and enabling new business models in nearly every industry and organization. According to IDC, AI will generate a cumulative global economic impact of $20 trillion or 3.5% of the global GDP by 2030. The generalized cloud infrastructure that drove the cloud revolution beginning in the 2000s was built to host websites, databases, and SaaS apps that have fundamentally different needs than the high performance requirements of AI. As workloads and tech evolve, so too must infrastructure and cloud software and services that power them. We believe we are at the start of a new cloud era that will drive the AI revolution. The opportunity for purposeful AI cloud platform, including infra and integrated software, is massive. Based on market research from Bloomberg Intelligence, total spending of AI inference, fine-tuning, AI workload monitoring, and training infrastructure, including AI service, AI storage, training, compute, cloud workloads, and networking, will reach approximately $399 billion by 2028. For AI to reach its full potential, it needs to be purpose-built AI cloud platform with infra and managed cloud services that are delivered in an efficient, automated, highly performant way. Enter CoreWeave AI hyperscaler. We purpose-built our CoreWeave cloud platform to be the infrastructure AI application platform AI. Our platform manages the complexity of engineering, assembly, running, and monitoring state-of-the-art infra at massive scale to deliver high performance and efficient AI workloads. Through our proprietary software capabilities, we enable our customers to achieve substantially higher total system performance and more favorable uptime relative to other AI offerings within existing infra cloud environments and unlock speed at scale. For example, in June 2023, our NVIDIA H100 Tensor Core GPU training cluster completed the ML-Perf benchmark test. Which benchmarks how quickly a system can train a model from scratch in 11 minutes, a record and 29 times faster than the next best competitor at the time of the benchmark test. And the time was June 2023. Okay, well, we're in 2025. So these efficiencies also extend from training to inference use cases as our CoreWeave cloud platform significantly improves both runtime efficiency for inference workloads and enables overall higher AI application uptime. These performance gains help to ensure lower performance adjusted costs and a superior end user experience. Supercomputers will build to power our platform, are optimized to support many types of AI workloads. Our multidisciplinary customer-centric team has a proven ability to conceptualize, blah, blah, blah. Customers utilize their platform to a set of cloud services comprising infrastructure services. As of December 31, our 32 data centers were running more than 250,000 GPUs in total and were supported by more than 360 megawatt of active power. Our total contracted power extends to approximately 1.3 gigawatt as of December 31, 2024, which we expect to roll out over the coming years. So they're using 1/4 of what they contracted. Okay. Interesting. That's actually pretty interesting because I was told the electricity generation was the limiting factor here. So how does that work? That doesn't make much sense, right? Am I missing something here? Let me read that part again. Our CoreWeave cloud platform is hosted in our distributed network of active purpose-built data centers that are interconnected using low latency connections to major metropolitan areas and incorporate state-of-the-art data center networking equipment, enhance access to power, and where appropriate, the latest liquid cooling technologies. As of December 31, our 32 data centers were running more than 250,000 GPUs in total and were supported by more than 360 megawatt of active power. Our total contracted power extends to approximately 1.3 gigawatts as of December 31, 2024, which we expect to roll out over the coming years. That makes no sense. That makes no sense. Give me 1 second. Let's see. 1 megawatt can power roughly 750 to 1,000 homes in the US. So 360 megawatts is like powering a small city. We plan to gradually activate this additional power capacity as they expand their infrastructure and bring new data centers or more GPUs online. Access to more than 3.5 times the amount of power. Um, at first glance, this does seem to contradict the common narrative that power is the bottleneck for AI data center growth, but there's an important nuance here. Contracted power doesn't mean it's available now. When CoreWeave says they have 1.3 gigawatts of contracted power, it means they've secured future access to that much capacity through agreements with utilities and infrastructure partners. It doesn't mean the power is currently online or ready to use. The grid has already built the infrastructure to support it, or that the power delivery timeline is short. Sometimes these contracts like to stretch years into the future. Okay, okay, cool. That makes sense. We benefit from robust collaborations with leading chip makers, original equipment manufacturers, and software providers to supply us with the infrastructure components and other products. We have a proven track record of rapidly expanding our power capacity to support the growth of our data center footprint with our collection of managed cloud services. We deploy a sophisticated financing strategy that have efficiently financed the development of additional compute capacity. Oh my gosh, sophisticated financing strategy kind of sounds like MicroStrategy. Um, Additional compute capacity through the use of asset-backed debts, having raised total commitments of $12.9 billion in debt through December 31 to support the development of our platform. Our customers include some of the world's leading AI labs and AI enterprises, the builders and integrators of AI, who depend on our platform for their core products and most promising innovations. We deliver significant benefits to our customers in terms of overall performance, time to market, and reduced cost of ownership, which results in our customers making large long-term initial commitments and expanding those commitments with us over time. The vast majority of our revenue today is from multi-year committed contracts, whereby a customer purchases access to our platform over the contract term on a take or pay basis. We also sell access to our platform on an on-demand basis through a pay-as-you-go model. As of December 31, we had $15 billion of remaining performance obligations and reflect an increase of 53% from $9.9 billion as of December 31, 2023. Microsoft, our largest customer for the years ending December 31, 2023 and 2024, will represent less than 50% of our expected future committed contract revenues when combining our RPO balance of $15 billion and up to $11.5 billion for future revenue from our recently signed master service agreement with OpenAI, as described herein. Our ability to abstract away the complex of our customers would face assembling, managing, and deploying this infrastructure themselves, established as a critical partner and leads to long-term durable relationships. I mean, I just don't know why AWS or Azure or others couldn't do what CoreWeave is doing. So there's no answer to that so far. Um, and they have financing. These guys have to drum up financing. They have better balance sheets than this guy. Yeah. They basically benefited from the AI gold rush in the last 2 years, show these and trying to IPO on these insane growth rates, but they're losing money. So, um, and now the bubble is bursting too. So I don't see how this company can trade at these levels for long. Um, some of the most ambitious computing testing projects in the world are powered by our platform, and our business has grown rapidly since our inception. Our revenue was 16, 229, and 1.9 billion for the years ended December, etc. Okay, we're gonna get to that. So I'm gonna leave this at industry background. I'm gonna check the balance sheet real quick, if I see anything. So the one thing I want to see is how in the world is their operating margin so high, yet they lose so much money. Um, Operating income of $324 million in 2024, and then they have loss on fair value adjustments and an interest expense of 360 million. Jeez, that's crazy. So their interest expense is more than their operating income, and then they have a bunch of loss on fair value adjustments. We don't know what that is at this point. Provision for income taxes. Okay, let's look at that real quick. Actually, I just want to watch the balance sheet first, and then we're going to go into balance sheet. Total liabilities 15.5 billion. Total assets 19.5 billion. Okay. Debt non-current 5.5 billion. Where's the current debt? How is this a balance sheet? What the fuck is this? 8 billion of total debt as of December 31. Um, Delayed draw term loan facility 1 and then 2. That's most of it. About 4 or 5 billion, $6 billion. And the original equipment manufacturing financing arrangements. Yikes. I wonder if that's NVIDIA. Okay. Consolidated balance sheets. Okay. Here's a real balance sheet. December 31, 2024. 18 billion in assets, 17 billion total liabilities. Okay. Redeemable convertible preferred stock of 1.7 billion. Interesting. Debt current 2.5 billion. Debt non-current 5.5. So you're looking at 8 billion right there. And then there's some deferred revenue. Interesting. Deferred revenue, non-current is 3.3 billion. Current is 700 million. So it's $4 billion of deferred revenue. That's very interesting. That's a lot of deferred revenue as a percentage of your assets. Um, Little goodwill, 19 million. That's nothing. Property and equipment, $12 billion. Hmm. So that's, we said, yeah. So most of that is GPUs. Most of those GPUs. I don't know what their depreciation policy is like, but Jensen said Blackwell. When Blackwell comes, you can't give away Hoppers. So I don't know what the value of Hopper GPUs on this balance sheet should be marked down to, but there's a big risk on the balance sheet here, which is if they end up marking down their Hopper GPUs billions of dollars, if they're depreciating in fact faster than their depreciation expense, then there's a big um, asset side risk here. Accounts receivable, $400 million, 2.5 times. It grew 2.5 times in the last year. I mean, given their revenue growth, it's not that abnormal. I thought some people were kind of complaining about this, but that's not the big deal here, I don't think. $1.4 billion of cash and cash equivalents. Okay. Accumulated deficit of 1.5 billion. Okay. All right, now let's look at the loss on fair value adjustments. Loss on fair value consists of gains and losses as a result of recording a derivative and warrant liabilities at fair value at the end of each reporting period, as well as recording our warrants and embedded derivatives prior to settlement of the associated instruments. That's very interesting. The increase in loss on fair value adjustment was driven by an increase in valuation of derivatives and warrants tied to our common stock and redeemable convertible preferred stock within the periods presented. For adjusted EBITDA, they exclude these loss on fair value adjustments, depreciation versus interest expense, etc. And then they show adjusted EBITDA $1.2 billion. On a quarterly basis, loss on fair value adjustments has varied significantly during each period presented. This variable is based on the valuation of derivatives and warrants tied to our common stock and redeemable convertible preferred stock within the periods presented. In the quarter ended September 30, 2024, all of the outstanding 2021 convertible senior notes converted into shares of common stock. And as a result, the fair value adjustments recorded in the quarter ended December 31, 2021 decreased relative to prior periods. Okay. They show quarterly results for 2024. Okay. I'm gonna have to look into that later, a little bit more on my own. All right, let's do a quick market search, see if there's anything. The markets are coming down a little bit here. Dow Jones, let's see, S&P 500 is down from about 5,700 to 5,664. That's about, is that about a 1% drop? Yeah. Russell 2000 is down as well. Across the board, they're down a little bit. It's going to be low volume until the close, I think, unless something leaks. But Tesla's up 5%. Hertz is up 6%. I'm looking at Hertz and Avis for a potential short, but we'll see. Ford is up 2%. Also, I think there's a possibility that the economy shows negative growth right now in Q1. It's going to be negative growth, whichever you slice and dice it. And it's not because of the gold trade. It's mostly because of some net exports, um, but also because of spending drop as well. So it's not just the import exports that's showing weakness. And all these manufacturers accelerated their imports in Q1, trying to get ahead of the tariff increase. But also, I think consumers accelerated their purchases as well, especially in automotive. So the fact that Tesla missed its deliveries estimate this badly, even drastically lowered estimates, even with the tailwind of some people increasing their purchases in March, is very bad. It means Q2 could be even worse. I think Tesla's Q2 will be even worse. So, to the extent that some people may not have sold their shares, I think this pop is a blessing for you, and you might want to take advantage of it. But obviously, it depends on personal situation. All right, with that, we're going to end it here. Thank you very much, everybody, and I will chat with you all next time. Take care.